Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, September 23rd, 2016. It's about 1:48 p.m. Eastern Time now as I'm doing this video, so this will be a wrap up for the week and really an outlook for the, markets going forward. And what I want to do is just touch on all time frames lightly, not go in depth in any one time frame, just kind of go over what's happening. And most importantly, I want to start out here with the longer term charts. Now, keep in mind, this formulates, as I often say, my overall bias, and that's why we've had some very whippy price action in the markets recently with the breakdowns 2 weeks ago. I mean, like I mentioned in an update today on the trade ideas, by all accounts, that breakdown we had a few weeks ago, 2 weeks ago actually, to the day, I believe. By all accounts, it was the real deal, and it proved to be a whipsaw signal. And I'll talk on that a little more when we get to the 60-minute charts. But let's start here with the weekly charts and just reaffirm or go over what I've gone over for weeks and really months now. This is a weekly chart of the S&P 500. You have various uptrend lines here. You have this yellow uptrend line off the 2009 lows. You have this blue uptrend line that did a good job, both which have been taken out. And then we've had, as we all know, the markets have gone nowhere, exactly nowhere in 2 years now. They've traded in a sideways trading range, going back all the way from back in looks like September right here of 2014. So 2 years, and we're about where we were then within basis points, within a percent or so. That's a sideways market. You can call it a deer market. You can call it a top. I know the bulls say that's just how the market is working off the overbought conditions and making a sideways consolidation before it makes the next thrust up, where bears are saying that's a top forming. I'm in the latter camp, as most of you know. This is a broadening wedge pattern here, these white lines, and looks fully mature. We had several couple touches on the top and bottom, and most importantly, we have these negative divergences on the weekly time frame that I've talked about. This, in large part, is what says that this is more than likely a consolidation before a major leg down versus a consolidation with the new highs to come. You can see the PPO just now crossing over, doing a bearish cross too. And when you get those bearish crosses, you tend to have at least several weeks of downside in the market. So we'll see. We're still at a pretty key inflection point. Market's still flirting with new highs. At least the Nasdaq is. The S&P and everything else is a little off. But I just wanted to formulate or touch on my bigger picture, especially for those new to the site. So these are levels we watch. I don't have this chart marked up with all the levels, but ultimately this is a target I'm looking for down here in the coming year or so, around 1580. And let's go ahead and look at one other. We won't go over all the indices, no need. We'll just look at the big two that I follow: the S&P 500 and the NDX, the Nasdaq 100. And various trend lines that broke along the way, but this is our primary uptrend line, the purple trend line. The Nasdaq actually bottomed, was one of the few indices that bottomed back on in late '08, made a slightly higher low back in March of '09 when everything else bottomed. So you can draw trend lines off either one, and I do have both, but all those have been broken, and you can see the breakdown and back test of that primary uptrend line. Then we had this alternative, this white uptrend line that I'm highlighting here, very well defined, and also breakdown, back test again. And most importantly are these series of divergent highs, long-standing multi-year divergent highs, which typically mark a meaningful reversal. They portend a lasting trend change in the market, unless they're burned through. So the bullish cases I keep talking about, we come up and take out these new highs impulsively, the recent highs impulsively. So far, we've failed. Everything but the Nasdaq 100 failed the recent breakout of the new highs. And as I've talked about a lot, this market is dangerously being held up by fewer and fewer big names, and we all know what those are, the mega caps. Apple, I'm just looking at my 1-minute chart today. Apple's coming under some heavy selling right now, but that's one of the few recently that's been doing well. But you got your Facebook, Amazon, the FANGs, and certain big ultra mega cap, usually tech stocks that have been holding this market up. So that's the bigger picture, and I don't see anything that has changed. In fact, not a thing has changed in weeks or months on that. This isn't the chart I wanted to show on the NASDAQ 100. Let's see what other boards I have here. Yeah, this one's better shown on my daily chart I'm sorry, the daily time frame, 2-year period, daily chart of the QQQ, the NASDAQ 100 tracking ETF. You know, the bigger picture is right here. This line from this peak back here to this peak, we have very strong, clear negative divergence, you know, with both the RSI and the MACD either making a lower high or a equal high, in this case a roughly equal high. That's still negative divergence since prices made a higher high against the indicators failing to do so. And then, of course, you had these smaller divergences, each one pointed out before. They've all resulted in corrections, all these divergent highs. But the big thing is this larger picture, this divergent high here, and that's the NASDAQ 100 tracking ETF. Now we look at the S&P 500, and we have even more powerful divergent high. We have signs of a possible top already in place on the S&P 500. We'll see if that proves to be the top. There's a good chance it will. When I hold the line here, the crosshairs, you look at the vertical line going all the way up, and that marks the high back there, the peak. In the S&P 500, you can see it was confirmed. I already went over this. A series of 3 divergences led up to this high in the top in 2015, followed by that waterfall sell-off. Divergent high number 1, divergent high number 2, and divergent high number 3, which make one larger divergent high. You can see down here. And you know, we had a divergent low, led to that rally, and here's a series of 3 consecutive divergent highs. So far, prices have failed to take out that high, and even if they happen to get up there and the S&P manages to punch out to new highs, as you can see here, the RSI and the MACD are severely lagging, and any new high, if it comes, at least if it comes in the next couple of weeks here, is more than likely to be just another divergent high. And personally, that's just my trading style. I have my rules. My rules might not always be set in stone. Sometimes I'll modify my trading plan, my stops, or my profit targets. But one thing I don't do is chase a breakout with clear negative divergence across just about all time frames, especially the longer term time frames. So there's the bigger picture, and just something to talk on real quick about what I like to say, being early or being wrong. Let's take a look at the Qs, for example, here. Oh, yeah, okay, there's a clean. Let's say that you pointed out divergences here, as I did back then, and I have here, and you were bearish. You know, you see the divergences forming, and you're bearish at this point here, and the market goes higher. Well, the difference early and wrong, let's say you're looking for a significant pullback, you know, one of 10% or more. So you're bearish here. You can be bearish for weeks or months. In this case, with that those series of divergent highs, the markets never went higher. When you see where the divergences are, you know, and that was a Qs had a little blow off top, a little micro or mini blow off top, but it still only went about 2.5% above this level here, and then it fell down in one, you know, not short order, I shouldn't say one day, dropped down about 25%. And, you know, I talked about this trading range that went on for the end of, throughout the end of 2015. And then we finally had the spark, the catalyst. That was that breakdown below that trading range. I made mention of that today in one of the updates. It was comparable on a much larger scale to the recent breakdown that we had here below this trading range, but that proved to be a whipsaw signal so far. But that one was a real deal, and many others. You know, traded for years, and you get these tight trading ranges, and if the indicators, oscillators, everything else confirms a downside break is likely, you still can't jump the gun because anything's possible. You can get an upside break of these ranges, but you have to respect it, and when you get it, you need to jump on it. So as I said today, I would do this you know, 100 times again in the future, and only if shorting a confirmed impulsive breakdown like this with impulsive price action, high volume, especially out of a well-watched trading range, if for the next 100 times that I shorted that, I were to be stopped out, let's say 70 or 80 times, at that point I would say, you know what, this doesn't work anymore. But I can tell you historically, much more often than not, when you have a sell signal like this, especially confirmed by just about all metrics I follow, that's legit. So this time it happened to be a false signal, whatever reason. I won't even speculate, and whether it was the big boys that can run the market and move a low volume market, or whether there's more buyers than sellers in this market and it was a true bear trap. One thing I mentioned in the update that I posted today earlier when updating the trade ideas, and I made some comments on the market, is if this was a bear trap, from my experience, just like bull traps are very powerful, so are bear traps. Here's the S&P 500, the broad market, much more diversified than the NASDAQ 100. If this breakdown, and I should clarify for those of you not familiar, again, if you're new to the site, I've been harping on this sideways trading range for a long time. So up to this point, there was a breakdown. We had a comparable, very well-defined sideways trading range in the Qs and everything else. This breakdown right here, as I said, by all accounts, looked like the real deal, but prices, after that, they snapped back in the trading range on the SPY, fell back down, challenge below, just got up. This was Fed induced the other day, and as I said, that's very common to see noise and whipsaw signals following a Fed meeting. So, in hindsight, to play that game, and I think it's healthy when you're a trader to kind of look at your mistakes, maybe the fact we were that close. And I knew the FOMC meeting was coming up, but it was still a few weeks out at that point. This happened 2 weeks ago. And in hindsight, we probably didn't get the follow-through buying because we were so close and there were too many traders wanting to hold off on positioning and do much before the Fed came out. And that would be probably my one criticism for going a little more aggressively short than I might maybe should have. You're so close to a big FOMC meeting. They're not all big, but that one was expected to be big. There was starting to be a lot of buzz about whether they should finally raise rates or not, or if they weren't going to. So there it is. Now, I'm digressing a bit, but I wanted to clarify or continue on my point. In all the years of trading, I always say this: fewer things are more powerful in trading than a false or failed breakout, or whether it's to the upside or to the downside. In other words, bull and bear traps. So, if let's say you want to consider this a bear trap, it's certainly a false breakdown, a whipsaw signal, but it's not a bear trap, at least not yet. It had the potential to be, but if it were, and there were a lot of buyers in this market, like I say, bull traps and bear traps are often followed by very sharp and powerful moves to the other side. And even when they came out and the Fed gave everybody what they want, they didn't raise rates. And for the first time, I believe ever, Yellen wouldn't even cite a reason. She just said, well, we're not citing a reason. We've hit all our metrics that we said we would raise rates before, but we just don't think it's the time, which pretty much says they're never going to raise rates, or at least that's the consensus. They will raise rates. I don't mean to speak literally there, but all right. So another instance where, rates weren't raised. We know they're not going to do it at the November meeting right in front of the election. So that gives us till at least December. Why haven't the bulls ramped this market up? Why haven't they taken this false breakdown, this bull trap, and blasted us up and through this trading range? That is what I would expect. That would be healthy action. And it may still happen, but it hasn't happened yet. And usually after very well watched breakdowns like this, it's not very long before you see a very sharp and persistent reversal, because what happens, the shorts are squeezed out. The traders know that, and they'll come in and start buying, and they'll force that short covering. Natural buyers step in saying, okay, this market's never going to go down. I've been bullish, but I didn't know where to enter. Now I see the bears don't have the gumption or gusto to take it down. Now's my time to jump in, especially if we break out the new highs. Well, that hasn't happened. So that's something that I'm watching, and we're really back in that range now. Let's try not to read too much into it. Those are just my thoughts, my suspicion. That's how I read the market. That's my take. I may be wrong, but we're back in that range. And I would say the bulls have no business in letting us drop back below there, and especially this would be the critical level, move back below the recent lows. That would certainly be the most bearish. So bearish technical event number one would be a break back below the range, and then bearish technical number event, which would probably seal the deal, would be a break below those recent lows that we had over the last couple weeks. And again, SPY, mid caps, everything else, they have yet to take out the highs. The Qs are doing it only from the help of a handful of stocks, and I expect that breakout will fail. It hasn't been very impulsive. That's one thing you want to see on a breakout. We took out the top of the range, but where's the impulsive buying? We're already back to that 118 level. I mentioned that was pretty much the top of the range. And if we fall back below 118, that's not a good sign. Now we're back in the range. The very least, take this away. If you're getting chopped into pieces lately or have a tough time trading, you're not alone. I don't, I would love to meet the guy who said he's slaying this market, long or short or both. This has just been a sideways market. This has been one whipsaw of confirmed breakdown. Now a breakout without any follow through, especially on the other markets. It's failing. This is not. This market is not very conducive to swing trading. However, don't give up. We've been in a multi-month sideways trading range. As I mentioned before, the Bollinger Bands had pinched to levels not seen in years, and there is most likely a big move coming. And remember that right now we're in the seasonality, the time of the year where we've had a lot of big moves, especially on the downside. If you take a look at the charts going back the last few years, just take a look at September, October, in those months. That's usually when the big down moves have come. So. And the charts, again, still indicate that, but we have to stay open to all possibilities. If the Qs hold this level, move up, and if the SPY gets back up in there and breaks above its trading range, there's no way to spin that but bullish. That's the long end of it. Okay, so while we're here, just to recap what's happened, I posted an update on this morning. We had the Qs most recently, the price action, besides getting back above there, we had this uptrend line break right here, and a back test tried to creep up inside that uptrend line for a few. These are 60-minute candlesticks, but closed the day back on it. So we pretty much closed the day on that as a back test, and so far we're moving down below. So that was what we call a successful back test. We back tested, but now we're moving back lower. And trend indicators, everything's a mess. Just keep that in mind. When you get in these sideways, sloppy trading ranges, trend indicators don't work well. So I'm not highlighting these as much lately. I was before. We had some buy and sell signals, but then it proved to be, you can see here some whipsaws. And let's try to not squeeze water from a rock. There's just not much you can take out of these trend indicators. They're best used when you have clean separation like this buy signal or this sell signal, and then you turn into a buy signal. But again, we're still in a sideways trading range, so let's try to not take too much into that. Okay, we'll wrap this video up with a quick update on gold and the miners. This is the gold GLD daily chart. This divergent high was pointed out here. We had these, these are all different lines and levels that mean something, but most importantly was this this uptrend line here after gold hit that pullback target back here, 1570 a while back on that first big correction. We formed a nice, you can see well-defined 1, 2, and then numerous reactions there. So several reactions formed this uptrend line. Gold broke below it and has been moving down in a confirmed uptrend sense. What I mean by confirmed uptrend? Well, an uptrend is simply defined as prices making a series of lower lows and lower highs. That's what we have here. See, each high is lower so far. I've put a couple downtrend lines you can see here. This yellow downtrend line, minor downtrend line, and then this one. This is what I would call the primary downtrend line, if you will. There's only a few reactions at this point. This one has about 3 reactions as of today. So these aren't super valid. In my book, it takes 3 reactions to validate a trend line because any 2 points can be drawn at random. So these are, this one may be validated today, especially if we have a reversal. We haven't really had a reaction yet. We've stopped at it, and that's in a sense a reaction, but let's see if we pull back. That will further validate that. Trend indicators look to have flipped bearish. I often talk about the MACD trading above or below the 0 line, and it's below the 0 line right now. And again, this all follows this divergent high. But gold has some work to do. And what it's done since that breakdown, this was my first target here, support T1. Even though gold's not an official trade, I've tracked gold to know where the miners are going. I like to trade the miners because there's more juice. If you get the call on gold right, and you can call a 5% call, you're going to make 15 or 20 on the miners in either direction, usually, something like that. So there's gold, and you can see 1, 2 successful defenses of that 125.15-ish level. It's not a hard level, but it's a pretty, it's come pretty close within there both times and had a bounce. So this is what we need to see go. And now I would lower that line at this point. That line was drawn for these reaction lows and this reaction high back here. But at this point, you want to watch those recent lows, and that comes in about 124.50, call it. So move below 124.50 will more than likely be the catalyst for a move down in gold to this level. And if you're bullish, looking for some bullish technical events on gold, until and unless this downtrend is reversed, the first thing would be a breakout. I would put more emphasis in this second uptrend line here, because gold needs to really take out or negate this current downtrend. You have to take out the previous reaction high. So you have a reaction high here, you have a reaction high here, and a reaction high here. So simply put, each reaction high gold can take out. Now, if it can take out this reaction high and that downtrend line, that would certainly foil the current downtrend. Then you have this one not far ahead, and then there's, the previous highs. And if it can do that at this point, burn through all these divergences, it's probably going a lot higher. So there's your bullish case. If we get up here, even close to those new highs, we're probably going to go higher. But right now, I favor this downside scenario and a continued move down to that 120.56 level, somewhere in there. It might be, about 120.56, we'll call it. And we'll take it as it comes. So now let's look at the miners. Oh, well, let's look at silver. I would be remiss not to look at the, that's the silver miners, SLV. And SLV, same story. It's in a downtrend. We have these recent lows we need to take out. And this is my target area right here. That's around, it's hard to see because these numbers overlap, 117.30 down to 117.10. There's a gap there. And that would, for those of you, I know a lot of people are looking to get long on a pullback. This is a solid support level. We're in no man's land right now. Is it possible the pullback ended here? It's possible. I don't think so, but it's certainly possible. MACD still in bearish territory. There wasn't any positive divergence on the daily time frame here. You would have had to make a lower low here to have put in positive divergence, and I don't see that. So this looks like a lot like the stock market. We're consolidating, we're grinding around recently, and the next major move will probably come on an upside or a downside break of that trading range there that I highlighted, and that again would be my target, where I'd look to reel in short exposure and possibly go long. I can only tell you that if and when we get there. A lot of people ask, where would you go long? The charts help you look into the future, but it's not a crystal ball. In other words, if we grind around for a while and get there, how do the charts look? I like to see, ideally, a bullish divergence, positive divergence on the 60-minute time frame, at least before going long, especially when coming up to a support level. If so, that would be an ideal place to go long. But again, we'll just have to see how the intraday and the daily charts look if and when we get there. All right, GDX. You can see, same story. It's frustrating if you're depending on your patience level. I've got all the patience in the world. I've done this long enough, and these little rips and back and forth, they don't bother me, especially, I'm short nugget. I'll take it. The decay works in my favor. If you're long nugget or long dust, the decay is working against you as you have these back and forth choppy price action. That's GDX, and it's still an official trade. It's still profitable. It hasn't even threatened our stops yet. We reversed just shy of the first target at 24.85, which I had aggressively set right on my support level line. Most of I usually set my buy to cover orders a little bit above the actual support. But we had a key fib level just below that, which I think a lot of traders will watch too. You can see the dotted line. It's the 38.2 Fibonacci retracement. And then T2, which was price support first and foremost, going off these levels, but it was also lines up perfectly with that 50% Fibonacci retracement. And I'm referring to the move off the highs. So based on everything that I've seen and highlighted here, this is just a 4-hour chart we're on, but we had it on the daily chart as well. You can see there the big negative divergence, very steep, powerful divergence, a powerful rising wedge pattern, a breakdown, textbook price action for a breakdown of a bearish rising wedge confirmed with divergences coming off overbought levels. And as such, what I'm getting at here is I think at minimum GDX needs to come in and make a 38.2% retracement to fulfill that wedge breakdown. And I'm still holding out. T2 is still my second target, and I may not even go long there. I may not even cover there. We'll see. But Those are the levels right now that I'm watching. Those remain the price targets. So I just want to let you know that nothing at all on the charts on gold, GDX. I made mention today, one of the positions just slightly clipped its stops on the, it was a silver stock. Was it HL? I don't have time to go over that now. I'm going to wrap this video up here with the 25-minute mark. I'll update these trade ideas later, and like I said, I'll probably add any of the trades that were recently stopped out. I'll put back, but being that we've been in this choppy sideways market, better if you get stopped out, wait for signs of a confirmation. That's what I'm waiting for to add trades back. We're still in that trading range. To add them back now, let's say we grind around for another 2 or 3 weeks, we're just running the risk that we get stopped out again. I want to see some convincing evidence and I'm digressing away from the metals here. I'm talking on the broad market stuff, those semiconductor stocks, as well as some of these, though there was only one miner that was recently stopped out, and it had already hit its profit target. I'm trying to remember if that was HL or which one that was. CDE, I think. Yeah, HL still looks good. I don't think we've stopped out there. That's the one, CDE. I mentioned we shorted here on this intraday break. It looked like the real deal, but the mining sector held up. So CDE held up, and we'll most likely add that one back if I get a little more confirmation on the GDX, SIL, SLV charts, etc. But you look at this PPO or MACD down here. Tried to make a bullish cross, failed. Tried to make it again, failed. You can see that line's turned down. That is very bearish price action there. This thing just can't get even a crossover. Had a very muted bounce, had an initial bounce off that support and very muted bounce so far. So I think this one still looks good down to at least that T2 level at 866. But again, I'll save the trade updates for another video. This has been Randy Finney with Right Side of the Chart. Have a great weekend.